Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Dominique. It's great to have you on the podcast show.
Thanks, Bilal. It's great to talk to you.
So Dominique, you have to be perhaps one of the most outspoken and well-known economists now in the market. You were the only person a year or so ago calling for the Fed to raise rates to 7-8%. At a time, most people were looking for the Fed to raise rates to 2%. Now, the Fed is at 5.5%. So we're almost there at your target. And you're still looking for that move towards 7-8%. Yet everyone still is disagreeing with you despite your track record. So tell me, why are you sticking and holding on to your 7-8% target?
Because first, the 7-8% target is simply the Taylor rule. And in every Fed tightening cycle since the 1960s, inflation stabilization has required the Fed funds rate to get close to the Taylor rule. And the second reason, it's clear monetary policy is not transmitting to the economy. Look at growth. We are above target and accelerating.
And you mentioned the Taylor rule, and the Taylor rule is kind of well known amongst economists. I mean, it's not like you invented a new concept. The Powell knows this. Other economists know this. So, what has Powell and the Fed got wrong?
So, Powell and the Fed would like to be liked by people. They also have a very dovish outlook on the economy. If you look at their projection of inflation, they predict inflation by the end of the year will be twice as high as the target, so nearly 4%. So they are prepared to underwrite inflation at 4%. But if you look at their prediction of unemployment for the end of the year, they still see it below 4%. So clearly, this shows they are prepared to entertain higher inflation rather than take the pain of higher unemployment. So I think they have preferences that are shaped by a very long period of very low interest rates, and also recent deliberate decision to get closer to the public, to hold those public forums. The Fed listens. That makes it more difficult to inflict tough love on the economy.
And markets believe the Fed, despite the fact that inflation keeps coming out higher than expected in general. So how has the Fed been able to get away with this, or why doesn't the market call the bluff of the Fed?
Very good question. It could be cognitive dissonance, perhaps because what the Fed needs to do in order to stabilize inflation is too awful for the markets to admit it. So that is why they are sticking to their break-even at 2% for the foreseeable future. That's one reason.
Actually, one reason, when I ask this to some investors, I speak to some of the biggest investors in the world, and what they say is the direction of travel of inflation is great. Inflation was 10, 8, 9, 10% a year ago. Now it's down to 4-5%. So the direction is in the right direction. So we'll get to the destination of 2%. There's a disagreement about timing, but everything's working correctly in terms of change.
So definitely another factor here is the extrapolation of a trend, which I think is very dangerous because in terms of inflation, one model I'm really fond of is the BIS two regime, two regimes, a low inflation regime. You ignore inflation because it is so low. You practice something called rational inattention. So when you have shocks, they dissipate. Inflation is self-stabilizing. In the high inflation regime, you actually pay attention to inflation. You incorporate your inflation expectations in your price, your wage decision. Everybody does that. And as a result, economic agent converge to the same inflation expectation that is very sticky and it's very difficult and painful to move to the lower level. So what I think is going on at the moment is that we've had a big decline in energy prices. So we've had a decline in headline inflation. And because we are in the high inflation regime, this negative inflation shock has transmitted to the whole of the price structure. But if you look at energy prices, they're not falling anymore. So if we have a price shock, or if we have another positive inflation shock, you could almost also think about, strikes and their impact on wages down the road. I think we're going to see a reversal of the disinflation trend we've had for the past year or so. And not only reversal of headline disinflation, but reversal of core disinflation.
And one of the contrarian views that you've had is that you don't think the shelter component of inflation, which is the largest component, is necessarily going to fall. If anything, you think it's going to pick back up again. Can you talk more on that?
Certainly. If you look at investments in the residential sector relative to the demand, which is really driven by household formation, you can see very clearly that there has been a shortage of investment. You can also see it in that the average age of dwellings in the US has been going up. There is a strong anecdotal evidence that this reflects very restrictive zoning laws, especially in the coastal areas where you have well-off elite that doesn't want to see affordable housing or multifamily housing being built near their nice single-family houses. And that is one of the reasons we have such a low level of vacancies and why rents in the CPI are not coming down, and rents in indices such as Zillow, CoreLogic, Apartment List, that basically pick up rent contract currently being negotiated, so react much faster to the market than the housing costs in the CPI. Well, those indices are going up. They were going down last year, but this year they are going up.
And let me challenge you on the wages side, because that's another part of your argument of why inflation will remain sticky. We recently had a labor market report which showed that payrolls is less strong than as before. We had negative payrolls revisions, unemployment rate picked up. So all of these signs telling us there's a softening in the labor market. Job openings fell as well in the JOLTS report. So doesn't that tell you that the pressure in the labor market's been taken out, the labor shortage is disappearing, so you won't see this labor in wage inflation dynamic?
So what this is telling us is that we are moving closer to trend. So up to the first quarter of this year, we had huge increase in employment because you had a lot of people who were still on sideline because of the pandemic, and they were being brought back to the job market. Now we have much more normal employment growth, which is basically driven by labor supply. But if you look at the balance between demand and supply, it's not improving. Yes, we've had a 30 basis point increase in the rate of unemployment, but it's on the back of an increase in labor supply that's not sustainable. Participation from prime age women is the highest it's ever been. And so labor supply is stretched to the limit. And so we don't need huge increases in labor demand to continue to have a labor market that is stretched.
Now let's shift to the growth side overall. At the start of this year, most people, the consensus was that we'd have a recession in the first half of this year. Didn't happen. Then people said second half this year didn't happen or doesn't look likely to happen. Now people are saying maybe at the end of this year, early next year, it's going to happen. You were one of the few people to say we're not going to have a recession this year, and you continue to have that view. Why has the economy ended up being so much stronger than everyone thought?
3 reasons. Fiscal policy. We have on a cyclically adjusted basis, one of the widest budget deficit in the post-World War II period. Monetary policy, which I think is still loose, as shown by the recovery, for instance, in residential real estate, that is the most interest rate sensitive component of demand. Yet this quarter, it's going to add to growth. And the third reason is how the household savings rate is collapsing. We are back to the post-World War II lows that prevailed before the GFC.
Okay, they're very, very sort of good points. I mean, this begs the question then that why doesn't the Fed just raise rates? You know, given that financial conditions are so loose, given the Taylor rule. I mean, what is holding them back from hiking?
Well, I wish I could ask that question myself to Chair Powell. I think the Fed is very much driven by the experience of the past 20 years before the pandemic, where inflation was underperforming. I think the administration has also appointed governors who are very dovish. We've also had regional presidents who are very dovish. I think the Fed has tried to become more popular. It's adopted this forum. It holds regular forum, Fed Listens, to communicate with civil society.
And actually, on that, I mean, how would the presidential election next year affect Fed decision making? I mean, would that make them less keen to hike rates? They'll just like do nothing to prevent interfering with the election or something? Or
yeah, I think they definitely. I mean, you know, there is hard data. Almost 90% of Fed economists are registered Democrats. So there is no appetite to engineer a recession before the election. So even that is going to tie their hands even more. So yeah, there is a definite unwillingness to inflict pain on the American economy, or perhaps a more balanced way of conveying this is to say they have to be really convinced of the benefits, of the future benefits of inflicting pain on the US economy, which means they need evidence that inflation, strong evidence that inflation is not slowing down before they are prepared to be more aggressive.
And you know, in order for inflation to fall to 2%, what do they need to do?
Unfortunately, I think they need to engineer a recession because we are stuck in this high equilibrium, and it's very difficult since there is no coordination between wages and prices. It's very difficult to bring all agents' expectations of inflation in a synchronized manner to a lower equilibrium. So when this was done or attempted to be done in the 70s was through income policy. So agreed control of prices and wages. It didn't work out. This time around, those policies are politically and administratively unfeasible. So I'm afraid the only coordinating device, if you will, the only actions that will bring down everybody's expectations back to the low inflation equilibrium is going to be a recession.
And what about the external environment? I mean, China's slowing, Europe's slowing. I mean, could that bring the US into recession without the Fed having to do much?
I think it will do more for dollar strength than for economic weakness. Essentially, the US is much less dependent on external demand than the Eurozone or China.
Okay, now I've attacked your view lots of different ways, so let me actually ask you to attack your own view. I mean, how could you be wrong here?
So I could be wrong if there is indeed so I could be wrong if the economy is not as strong as I think, like for instance, big blowout in the banking system. Not my view, not impossible. I could be wrong if there is a huge disinflationary shock, oil prices collapsing back to 60. I could be wrong if there is a depression in the rest of the world. rather than a recession. So I could be wrong, basically, if we had disinflationary shocks strong enough to move us back to the low inflation regime.
Okay, yeah. Okay, no, I mean, these are all great views. So just to sort of summarize, I mean, you sounds like you're pretty bullish on the US growth picture. You're not in the recession camp. You'd only be in that camp if the Fed was to raise rates much more aggressively. So you need the Fed to drive the economy into recession rather than it falling into recession of its own accord. You think that we're not over in the hiking cycle, that it's premature to think that we're close to the end, and you don't agree with the market expecting easings for next year. You still are holding on to your view of a 7-8% terminal rate in the Fed. Is that a fair summary of your views?
Absolutely.
Okay, no, that's great. Now, before we wrap up this conversation, I do always like to ask a sort of a personal question or two for my own sort of personal benefit, if anything. But are there any good books or TV shows that you have read or watched recently?
So I'll talk about the TV shows because it's been a never-ending source of delight. So some favorites. So this show called Tehran, which is done by the public Israeli television, which pits the Mossad against their counterpart in Iran. And I loved it because it showed people are not that different, and also the complexity of Middle East culture and history.
So it's
and
not so one-sided. I mean, it's not just
definitely
kind of
no, really
okay.
not definitely
It's
not
impressive,
one-sided, and a great thriller. The other one is Dark Winds. This one is in the US. It's a series of a mystery on a Navajo reservation. Also a fantastic mystery. And you learn a lot about First Nations, which, as a newly minted American, I don't know much about, but it's a great show as well. Another one, and it's an Australian show about a hard-ass a female prosecutor. It's called Janet King. And I loved it because of the gender role being completely reversed. That was very enjoyable. And it's also a great thriller. So great entertainment. As
okay,
well
great.
as
No, thanks for those recommendations. I have not watched any of those, so I'll add them to my list. And now, just to wrap up, what's the best way for people to follow you?
Macro Hive. We have a high octane product for institutional investors, but we also have a product for retail investors. We have a newsletter that is free, so I hope that listeners will subscribe to it.
No, great. I hope they do as well. So once again, thank you, Dominique. As ever, it's great to speak to you. You have punchy views, and I urge everyone to listen to your arguments carefully and to follow you going forward as well.
Thanks, Bilal. Always fun to talk to you.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.